Right now, as we speak on this Friday morning, December 5, 2025, Circle Internet Group Inc., trading under the ticker CRCL on the New York Stock Exchange, is exchanging hands at $83.66. The market has opened with a decisive bearish sentiment for the stablecoin issuer, pushing the stock down by approximately 4.3% in early intraday trading. We are seeing a high volume of selling pressure right out of the gate, with over 2 million shares already traded within the first hour, signaling that institutional investors might be reevaluating their positions as we head into the weekend. The stock opened at $86.09, briefly touched a high of $86.12, and has since been sliding, finding temporary support around the $83.15 mark. This current price action places Circle roughly 72% below its 52-week high of nearly $300, a peak reached during the post-IPO euphoria back in June. The expectation surrounding Circle has always been one of inevitable dominance, the belief that as the issuer of USDC, it would effortlessly become the backbone of the global financial system, a digital equivalent to the Federal Reserve, but for the Internet age. Investors bought into the narrative that holding CRCL stock was a proxy for the adoption of digital dollars, a safe bet that would only go up as the world transitioned to blockchain rails. The reality, however, is proving to be far more nuanced and volatile. While the adoption of USDC is indeed growing, the company's tethering to interest rate environments and its heavy reliance on its partnership with Coinbase has introduced a layer of complexity that the initial IPO hype conveniently ignored. What we are witnessing today at the $83 level is not just a dip, it is a market-wide recalibration of what a stablecoin business is actually worth when stripped of its speculative premium. The tension here lies between the vision of a frictionless global currency and the gritty operational reality of a company whose primary revenue stream is effectively interest income on reserves, a model that looks suspiciously like a narrow bank, subject to the same macroeconomic headwinds that affect institutions like Fidelity or Schwab Intelligent Portfolios. When you look at the chart from June 2025 to today, you see a classic boom and bust cycle compressed into 6 months. The stock launched at $31, surged to nearly $300 in a speculative frenzy that drew in retail traders from every corner of the market, including those active on Robinhood stock trading and SoFi Invest. Now, as the dust settles, we are left with a company valued at roughly $20 billion, which is still substantial but a far cry from the $77 billion market cap it briefly commanded. This correction forces us to ask a critical question. Is Circle a technology growth play, or is it a yield-sensitive financial utility? The market seems confused, and that confusion is where the opportunity lies for the astute observer. The drop today could be attributed to renewed fears regarding Federal Reserve rate cuts in 2026. Since Circle generates the vast majority of its revenue from the interest earned on the relentless pile of treasuries backing USDC, any signal that rates will drop faster than anticipated is a direct hit to their bottom line. It is a simple equation that many retail investors, perhaps those used to the gamified interface of the Robinhood app, might overlook. Lower rates equal lower revenue for Circle, unless the volume of USDC in circulation expands massive enough to offset the yield compression. Let's shift gears to the operational mechanics. Circle is not just a passive holder of assets. It is actively building the infrastructure to move value across borders cheaper and faster than any legacy system. This is where the comparison to Apple stock or Tesla stock becomes relevant, not in terms of product, but in terms of ecosystem lock-in. Just as Apple locks you into iOS, Circle is racing to lock the global economy into the USDC standard. They are integrating with payment processors, convincing huge merchant banks to settle in USDC, and lobbying heavily in Washington. The passage of the Genius Act earlier this year was a significant legislative win, providing the regulatory moat that Circle has always craved. Unlike the Wild West days of crypto, Circle now operates with a stamp of approval that competitors like Tether lack in the United States. This regulatory safety is what attracts institutional capital, the kind of funds managed by Fidelity Investments and Fidelity Wealth Management divisions. These conservative giants cannot touch unregulated assets, but a regulated, publicly traded Circle is a different story. However, this safety comes at a cost: compliance. The overhead for maintaining this squeaky clean image is immense, eating into margins and slowing down the kind of aggressive expansion that crypto natives often demand. Engagement break. Comment below with your take. Do you think the regulatory moat Circle has built is strong enough to keep competitors like PayPal's stablecoin at bay, or will big tech eventually crush them? Analyzing the trading volume today, we see a distinct pattern of distribution. Large blocks are being sold, likely by early venture backers who are finally able to liquidate positions after the expiration of lockup periods. This is a classic supply overhang. When you have early investors who got in at valuations of $1 or $2 billion, selling at $20 billion is a massive win, regardless of whether the stock is at 80 or 300. This selling pressure creates a ceiling on the stock price, frustrating retail holders who might be averaging down in their individual brokerage accounts. It is crucial to understand that this supply dump does not necessarily reflect the fundamental health of the business, but rather the liquidity needs of early-stage funds. For the retail investor using interactive brokers or Fidelity ETFs, this period of consolidation might essentially be a waiting game until the shareholder base rotates from venture capitalists to long-term growth funds. We must also discuss the Coinbase factor. A significant portion of Circle's economics is tied to its arrangement with Coinbase, where they share the interest income generated from USDC reserves. This symbiotic relationship is both a strength and a weakness. It guarantees distribution. Coinbase users hold billions in USDC, but it also means Circle is not the sole beneficiary of its own success. If you are analyzing this stock, you have to look at Coinbase earnings as a leading indicator. If Coinbase reports a drop in USDC holdings on their platform, Circle will feel the pain. This is unlike Nvidia stock, where the demand is broad-based across thousands of clients. Circle has a high concentration risk with its primary partner. For those of you using Schwab Intelligent Portfolios or similar online investing tools to manage risk, this concentration should be a flashing yellow light. It implies that Circle doesn't completely control its own destiny in the way a fully independent software company might. Furthermore, the competitive landscape is intensifying. We are seeing traditional finance giants entering the tokenized asset space. Fidelity itself has been exploring tokenized funds. If banks start issuing their own regulated stablecoins or deposit tokens, the unique selling proposition of USDC could erode. Why would a bank use USDC when it can issue JPM coin or Citi token and keep all the interest income for itself? This is the existential threat that keeps Circle executives up at night. Their counter-argument is interoperability. A bank coin is usually stuck in that bank's walled garden. USDC is on Ethereum, Solana, Base, and a dozen other blockchains. It is the universal language of liquidity. This network effect is powerful, similar to how Microsoft Windows became the standard not because it was the best, but because it was everywhere. If Circle can maintain this ubiquity, they win. If the world fragments into hundreds of bank-specific coins, they lose. Let's look deeper at the financials without using the forbidden terms. The balance sheet is fortress-like, consisting almost entirely of short-term U.S. Treasuries and cash. This makes CRCL stock deeply correlated to the bond market. In a way, buying Circle is like buying a growth-wrapped Treasury ETF. For investors looking for investment help or using SoFi robo-advisor services, understanding this correlation is key. You are not just betting on crypto adoption, you are taking a view on the macro environment. If you believe we are entering a period of prolonged high rates, Circle is a cash cow. If you think we are going back to near zero rates, their revenue model needs a drastic pivot towards transaction fees, a pivot they have not yet successfully executed at scale. The current intraday drop suggests the market is pricing in that rate risk more